Everyone is often caught off guard by recessions. There's a good chance that neither will the next one. Economists have been saying for months that a recession is coming, and most of them think it could happen as soon as next year. Economists don't agree on how deep, long, or short it will be, but they do agree that the economy is about to go through a period of contraction. Mark Zandi, chief economist at Moody's Analytics, said, "Historically, when there is high inflation and the Fed raises interest rates to bring inflation down, it leads to a recession. This is a typical case of the economy getting too hot, which leads to a recession." This story has already been told. When interest rates go up because inflation is going up, the economy eventually collapses under the weight of the higher rates. Recessions tend to catch us by surprise, Zandi said. CEOs never talk about recessions. Now it seems like CEOs are falling over themselves to say that a recession is coming. Everyone on TV is talking about a coming recession. Every economist says that a recession is coming. I've never seen anything like it. Even though the Federal Reserve saved the economy during the last two recessions, it is now slowing it down. By lowering interest rates to zero and adding trillions of dollars in assets to its balance sheet, the central bank made it easier for people to borrow money. It is now getting rid of this balance sheet, and interest rates have gone from being close to zero in March to being between 4.25% and 4.5% this month. But during the last two recessions, the central bank did not have to worry about high inflation reducing the spending power of consumers and businesses, making its way into the economy through the supply chain, and causing wages to rise. Now, the Fed is in a tough fight against inflation. Early next year, officials at the central bank expect to raise interest rates again, this time to around 5.1%. Economists expect the central bank to keep rates high in the future to control inflation. High interest rates are already having an effect on the housing market. In November of last year, home sales dropped by 35.4%, making it the 10th month in a row that sales fell. The rate for a 30-year loan is around 7%. In November, the annual rate of inflation for consumers stayed at a comfortable 7.1%. Tom Simmons, a money market economist at Jefferies, said, "You need to take out your economics book and read it again. This recession will be like any other. When the transmission mechanism starts to work for the first time in the beginning of next year, we'll start to see a big drop in corporate profits margins. When that starts to happen, they will do something about it. Cut how much they spend. The first place we'll notice it will be in job cuts. We'll see it by the middle of next year, when economic growth and inflation slow down a lot. I'll be there," he said. A recession is a long-term drop in the economy that affects the whole economy and usually lasts for 2 quarters or more. The National Bureau of Economic Research is the authority on recessions. It looks at how deep a recession is, how widespread it is, and how long it lasts. If something gets bad enough, then we might call a recession. For example, the pandemic downturn in 2020 came on so quickly and had such a wide range of effects that it was bound to cause a recession, even though it only lasted a few months. Diane Swank, the chief economist at KPMG, said, "I have a small, thin hope, but hope is eternal. The good news is that we should be able to get back on our feet pretty quickly. We have a strong balance sheet, so if the Fed starts to loosen up, you might see rates go down. A balance sheet recession is not a recession caused by the Fed." The most recent economic forecasts from the Federal Reserve show that the economy will grow by 0.5% in 2023, but no recession is expected. Swank said, "We will have one because the Fed wants to make one. When you say growth will be zero and the unemployment rate will go up, it's clear that the Fed is predicting a recession but won't say so. The Fed says that the unemployment rate could go up to 4.6% next year, from 3.7% right now. No one knows how long the Federal Reserve will be able to keep interest rates this high. Futures traders think that by the end of 2023, the Fed will start lowering interest rates. In its own forecast, the Fed says that rates will go down starting in 2024. Swank thinks the Fed will have to lower higher interest rates at some point to cause a recession, but Simmons thinks the recession will last until late 2024. Simmons said, "The market makes it clear that the Fed will change its mind about rates. What people don't realize is that the Fed needs this in order to keep its credibility on inflation over the long term. Aftershocks caused the last two recessions to happen. Simmons says that the next recession